Joining me now is Aaron Sai, the market consultant for First Metro Securities. So good to have you on the show, Aaron. Thank you so much for joining us.
Yeah, thank you, Kathy, for having me here. Good morning.
Good morning. So give us some rhyme and reason here on how best to put your money to work with so much uncertainty and risk. If you were to pick a haven, which one is it going to be? Is it going to be gold, Bitcoin, or the more traditional picks like stocks, bonds, and currencies?
Yes, if we are talking about havens in terms of safety, definitely putting some of your portfolio in cash, given the still elevated rates, that the banks even give to even retail clients, is a good option. So we are getting at least 4% in interest for our money, for our cash balances in our banks. Then that's, I think, good enough, as far as safety is concerned. But of course, if for those long-term investors who have I think a height or maybe an appetite for risk. No, I think what we're seeing in the market, especially how the property sector is battered. No, if you're talking about the bigger developers, Ali and SM Prime, they both present more than 60%, no, more than 60% upside. No, from the close yesterday to the lowest consensus estimate, for their valuation. So I think again, when we talk about safe havens, it can be through safety, so cash can give you that. Good for us that the rates are still not going as low as expected, or as anticipated in the beginning of the year. They can still give us decent return, for that safety. But again, if for the more adventurous and more or longer time horizon, I think increasing exposure to stocks, especially for the big caps and cyclical names that are offering too much value to ignore, might be a good option also for those.
Well, rates of return are still good because the Banco Central decided to keep rates on hold, but there are the risks. And the governor himself said it's the global policy uncertainty that's really worrying him. What do you think is the bigger risk right now for market sentiment, Aaron? Do you think it's the reciprocal tariffs, or is it the mass deportations that could result in lower OFW remittances?
Well, I think no, I think the as far as the market is concerned, so the real economy, definitely the mass deportation, if it could come into fruition, again, as the statistics suggest, there are 350,000 unauthorized immigrants in the U.S. now coming from the Philippines. So if this 350,000 are really on their way, to be deported in the coming in the short term, in the short to medium term, and definitely the remittances that are coming, that have been coming from them, would be a hit, to GDP moving forward. But for the market, I think the more concerning factors for the financial markets is definitely the delay or the negation, of the expectation for lower rates. That's one. If the tariffs and all the fiscal policy adjustment of this new U.S. administration continues to point towards higher prices instead of lower prices, as anticipated in the last quarter of last year, towards the beginning of this year. If what would happen is an increase in prices instead, I think the market would really be at least steered steered, given that the expectation and the valuation are tuned towards the lowering of the rates moving forward. So if that lower expectation for lower rates are delayed at the very least, or even negated again, moving forward, then that is a big hit, and again, especially for the Philippine market, if the US dollar continues to increase, or to strengthen, given if the benchmark yields continue to be higher, moving forward, then that would not bode well, to Philippine equities, if the depreciation is continued to
Yeah,
be
but Aaron, the
anticipated in the
governor
horizon.
did say that they signaled that there will be a triple R cut before the April 3rd meeting. Wouldn't that be the de facto rate cut that the market would have probably anticipated? And which
Well,
would
that
be
can
good for
that
the markets because there's like at least 330 billion pesos going into the financial system that go into the investments that you just mentioned in stocks, bonds, and perhaps currencies.
Yeah, that's right. No, but again, most of the time, no, again, in the presence of volatility and uncertainty, especially in markets like the equities markets, no, most of the time, the release of money from the financial system given by our cuts do not, as we have seen, did not pala, no, did not go to risk markets like the equities market. No, most of them are actually just crowding out the fixed income market, which also drives the prices higher, no, the fixed income price higher, which is also what drove the decent returns or higher than expected returns in the fixed income market. So even if there's a promise or a direction or a guidance for a triple R cut moving forward, I'm not sure. No, I'm not sure if that would the investors would be incentivized, no, to expose their new cash, no, there's newly freed cash, no, to equities market given all these volatilities.
But this is a midterm election year, and that's what makes it different. When you look at the three midterm election years in the past, in 2017, 2019, 2013, and 2007, markets have risen. But in this
Yeah.
case, what would be the bigger worry or perhaps opportunity for those running for office? Do you think it's going to be failing economic growth or faster inflation?
I think the what should be maybe, you know, I'm not sure if what they would want to do now, but I think the priority could continue to be the faster economic growth. Now, even if there's some cause of inflation, I think faster economic growth would continue or would still benefit more. No, if we talk about our debt to GDP, if we have higher growth moving forward, then that would still be manageable. No, even if we finance our expenditures through more debt, no, which we have been doing recently. No, even if with the cost of inflation, I think that could have a bigger payoff. No, but again, of course, they have to be mindful of inflation, especially inflation does not just come from internally, no, and now with the volatility and the uncertainties now that the Trump administration has been quote unquote, no, and infecting the global economy, no, I think there should be a tighter watch to inflation moving forward.
So if you were to pick just stocks in your universe of assets, you made a mention of property, which other sectors would you recommend?
Again, given the good showing, no, given the good showing of consumers in the fourth quarter and anticipation of more consumer spending this year, no, aside from property, as mentioned earlier, Ali and SM Prime being cyclical and big caps, no, and huge upside in terms of valuation, we continue to like, no, consumers, no, so that would be your Jollibee, no, which from the closing price yesterday presents around 30% upside to its target at 330, no, and of course some of the staples, no, as we can see, consumers deploy more of their money this year, and in that case, we think Pure Gold and RH are good bets this year.
Great. Well, good to have you with us. Hopefully, it's going to be in the studio in the next run. Aaron Sai of First Metro Securities joining us live.